Hello financial fans, welcome back to another stock analysis. Today we'll be covering ASML, stock ticker ASML. ASML is a Dutch company that designs and manufactures photolithography systems used in the semiconductor industry to produce integrated circuits. Photolithography is the process of using light to transfer a pattern onto a substrate, and ASML systems use extreme ultraviolet UEV light, which they have got a monopoly on, to print precise patterns onto silicon wafers, enabling the creation of smaller, more complex chip designs. In essence, ASML provides the tools that enable chip makers to shrink the size of transistors and increase the number of transistors on a chip, resulting in more powerful and efficient chips. Currently, they have a market cap of 241.5 billion euros, and in 2021, their revenue was 21.2 billion euros. The dividend yield is sitting at 0.96%, and some of the customers include Toshiba, TSMC, Intel, Samsung, and Hynix. So very famous companies in the world. 73% of their revenue comes from system sales, so these machines, the UEV machines that we just talked about, and 27% from service and field option sales. 44% of their revenue is generated from Taiwan, so that's most likely Taiwan Semiconductor, 32% from Korea, which is Samsung, 12% from the United States, which is most likely Intel, and 11% from China, and the remaining 1% in Japan. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on financial ratios, the financial health, and the growth of the company. We'll be using a standard margin of safety of 25%, and the margin of safety can never be below 0%. This 25% basic margin of safety can either increase or decrease by the ratios that we're going to look at in just a moment. And the severity that this margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction. When we're using 3 colors in our scale, bright red will mean a 5% increase, orange will mean no change, and bright green will mean another 5% deduction from a margin of safety. First two metrics that we're going to look at are the EBIT growth and the margin growth. The EBIT has gone up, going from almost 1.3 billion euros in 2013 to 6.5 billion euros in 2022. The average growth in EBIT during this period was 21.8%, meaning a 10% deduction from a margin of safety. Margin has also gone up, going from 24.5% in 2013 to almost 31% in 2022. The average margin growth was 3.44%, meaning another 5% deduction from a margin of safety. The next two ratios are the dividend growth and the payout ratio. Dividends have gone up, going from 84 euro cents a share in 2014 to 3.33 euros a share annually in 2022. The average growth in dividends during this period was 28.7%, meaning a 10% deduction from a margin of safety. As you can see though, the dividends are kind of inconsistent and they don't get paid quarterly. Instead, they get paid every half year. Payout ratio is sitting at a very solid 35%, meaning no change in the margin of safety on this metric. Final two ratios are the debt to EBITDA and the return on invested capital. To get a debt to EBITDA ratio, we have to take the debt, subtract the cash from it, and divide it by the EBITDA. In this case for ASML, we already got the total debt, which is already the debt minus cash. In this case, that's 3.5 billion euros. And our EBITDA is 7 billion euros, leaving us with a debt to EBITDA ratio of 50%, meaning a 5% deduction from our margin of safety. The return on invested capital for ASML is sitting at 20.6%, meaning another 5% deduction from a margin of safety. Looking very good so far for ASML. Let's go look at the valuation models next to determine the intrinsic value of ASML. First valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow going from 2012 to 2021. The average growth in free cash flow during this period for ASML was almost 50%, and I'm projecting a 9% growth rate in free cash flow for the next 10 years for ASML. With this percentage, we can determine the future free cash flow of ASML and determine a terminal year valuation, using a 3% perpetual growth rate and a discount rate of 9%. This leaves us with a sum of free cash flow of 291.2 billion euros. All that's left to do to get our equity value is add the cash and equivalents and subtract the debt. In this case, this leaves us with an equity value of 287.7 billion euros. And all that's left to do to get a discounted cash flow price per share is divided by the amount of shares outstanding. Then out of this model, we get a discounted cash flow price per share, €713.61. And with the current price of €602.50, we get an upside of €111.11. It says here dollars, but it's supposed to be euros, which is almost a 18.5% upside. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts going from 4 years ago to the current year. The average growth in dividends during this period was only 2.67%, but I'm still projecting an 8.5% growth rate for ASML, seeing as they achieved that in the past as well, with an average growth rate that we just looked at of almost 30%. This model will also once again be using a discount rate of 9%, and doing this the calculation, we get a discounted dividend model price per share of €722.61, and with the current price of €602.50, out of this model we get an upside of €120.11, which is almost a 20% upside. The last model that we'll be using is the multiple valuation. In this model we'll be looking at similar companies to ASML, look at their stock price and the earnings per share. This way we can determine the average PE multiple in the industry, which in this case is 30.05. All that stuff to do to get our fair value is to multiply it by the earnings per share that ASML is generating, which in this case is €15.36 a share. This leaves us with a fair value of €461.63. And with the current price of €602.50, we get a downside of €140.87, which is almost a 23.5% downside. In this case, I will not be using this model in the final overview of our valuation, since ASML is a different company to all of these, with a monopoly on EUV lithography systems. So these companies are kind of similar, but not really. They're not as far as ASML yet. But let's go look at the final overview of our valuation models next. Looking at our final overview, we've imported the discounted cash flow and discounted dividend model prices per share. Out of this we get an average of €780.11. Margin of safety we have determined earlier, using a standard margin of safety 25%, deducting 5% for the debt to EBITDA, deducting 10% for the EBIT growth, deducting 5% for the margin growth, deducting 5% for return on invested capital, deducting 10% for the dividend growth. This would usually be a margin of safety of minus 10%, but we have said earlier, the margin of safety can never be below 0%, so no premiums will be paid. In this case, the fair value then is the same out of the average of the models, which is €718.11. And with the current price of €602.50, we had an upside of 19.19%. So in this case, it would still be a buy. If there's any other dividend companies that you would like to see me cover on this channel, please let me know in the comments. And thanks for watching.